Good morning and welcome back to the latest edition on the InvestTalk market analysis for the week ending May 16th, 2025. And today's video is titled Tariff Detent, OPEX, and a U.S. rating downgrade. What happens next? It's a big week. It's been a big week. It's been a long week. It's crazy to think that this pullback to 30% tariffs was less than a week ago. But nonetheless, markets have moved and, a lot has happened. So let's dig into this. And we start off with, the 1 week kind of heat map. You can kind of see where things were strong. Obviously, names like NVIDIA were the strongest, and Tesla, not a shock, markets up. Those tend to be the most volatile, etc. You had a few laggers, especially the healthcare space. AbbVie was down on the week. You had Merck down, Johnson & Johnson down. So certainly a rougher week for those names. And even if you look at Lilly, Abbott, all these other names, they were flat on the week on a bullish move in markets. So definitely a lot of underperformance there around drug pricing and new HHS appointees that are really not big fans of big pharma. And so, that's where a lot of the weakness was. You see most of the medical device companies pretty strong. Stryker up 3, Intuitive Surgical up 4, etc. So if it was medical device related, it kind of got a pass. Medtronic, right, up 3.5. But if you were pharma related, and I'm saying this for a while, not what you want to see. You also had United Health have that criminal charge on, I think, it was Medicare fraud. T-Mobile down. So see pockets of weakness, but overall, it was certainly a positive week. Now, before I dig into the charts, let's go over the economic news. We did have a lot this week, starting on Tuesday. You had CPI come in that did accelerate a bit, but wasn't really any major issue. Didn't really break out in a big way. Now, what you have to remember about CPI, it's actually pretty lagging. It's not the indicator you want to look at for real-time inflation numbers, because that stuff tends to filter in. The drivers of inflation tend to filter in over time, as opposed to hit all at once, like the tariffs, right? And so the tariffs are going to probably be the effects of tariffs will be lagged and go out probably closer to the summer. Core CPI, that did accelerate as well, but once again, still within kind of this broader trend that it's been in for about a year. Continuous claims for unemployment. This is the labor market. It did accelerate a little bit after that pullback last week. But what you're seeing is this could potentially be breaking out, right? We're in this range between, call it 1.8 and 1.9 million continuous claims, meaning people that are still on the unemployment doles. And this is a better picture of the labor market, because it's not about just who's filing for unemployment, but also who's staying on unemployment, who's finding a job, etc. This broke out above 1.9 a few weeks ago, kind of in the midst of the tariff war, and it pulled back over the past, last week, and had a little acceleration this week. So we'll continue to watch this as a weekly series and something to really help understand what is happening with the labor market. Producer price index, that did that, and this is more real time, or not real time, more leading indicator of where inflation is going, because what producers are feeling, they'll pass on to the consumer. So the producer price index actually fell pretty dramatically. So, there really wasn't much to indicate that we've sparked inflation on that side. Same with the retail, and then the retail sales. Retail sales were down back to the roughly flat. Certainly missed expectations. I think expectations were like 0.3 positive. It was only 0.1 positive, right? So the market did react to that on Thursday. You definitely saw a bit of a risk-off sentiment to kind of the rotation in sectors, but something we'll be watching to see if the consumer, with the sentiment, I'll pull the sentiment up first. Sentiment was kind of at rock bottom. Right? Pull out all the way to the end. This is 2022. Yeah, it's the last time it's been there was June of 2022. Import prices, that did accelerate, so this is also a bit of a leading indicator as well. Import-export prices, so we'll be watching that, but nothing that's too telling. On the Fed watch, the move for the week was really less cuts. Okay, so you look 1 week ago, their best chance was 3 cuts, 36% that we got 3 cuts between now and the end of the year. Now the best chance is 2 cuts, 38% chance. Okay, and very small chance that we're going to get like 4 or something like that. So, the base case is starting to become 2 rate cuts, and then at the end of the week, you had the ratings downgrade of the S&P, and I'll show you what that's doing to bond prices. Okay, sorry, rating downgrade, I think was by the S&P of the U.S. Debt. So we'll look at that. So kind of a mixed picture. I think continuing with the economic data, there is risk to the upside of unemployment in the near term, as well as inflation in the medium term. And the consumer, will they bounce back this month? That's a big question. Now the markets bounce back, and so does typically drive spending. So we'll see if obviously that holds, which we'll talk about in a minute. I also wanted to highlight this because while there are some, certainly headwinds to the overall economy, these next 3 things are relative tailwinds. Okay, the first would be bank credit. So I talked before about how this was decelerating into the year, and we were kind of meandering basically up until Liberation Day. And then this started to accelerate. So we went from, roughly 3% growth all the way up to about 4.5% growth year over year of bank credit. And if we zoom out here, that's positive. Look at 2021 when this inflected higher and you had that huge rally, a huge growth in bank credit. And what happened to stocks in 2021? They did very well. But then this peaked in early 2022 and then started to decline, right? And that's when you had that big decline in equities. So this has been an uptrend. It was threatening to roll over, but now it's reaccelerated. But you have this last week did decelerate a little bit, but we'll see. This is still generally, you have to say it's positive, right? Because of this reacceleration. Remember, everyone says that the Fed or the Treasury creates dollars, and the Fed can create dollars, sure, but the banks, the commercial banks, these are all commercial banks, they are the ones that make the most dollars. If they're lending more, that's creating dollars in a fractional reserve banking system. That's how this works. Okay. Excuse me. And then you have the Treasury General Account, U.S. Treasury General Account, weekly average. Okay. So what you can see here is when this goes up, that is net negative for liquidity. And this actually rose in April. Right now, was this plan that they were going to issue a bunch of debt? Remember, this is a checking out. So the Treasury issues debt, money goes into the Treasury, pulls it out of the economy. So when this goes up, that's money going out of the economy. Okay. Now, typically, this is also spent down, and it spends back into the economy, and that's net positive. And that's kind of what happened over the past few weeks, right? We got from 600 all the way down to 575. So not dramatic, but certainly reversal of liquidity into the system, and a bit net positive. So those are 2 things, at least near term, that are net positive for liquidity. And then you have this, the spending bill. Now it was shot down by, I think, 5 conservatives went against it, and ultimately that is still up in the air. But what you can see is they're still trying to spend a lot of money. There's really the reason it was shot down by the Republicans was because there were a certain number of Republicans that were, more fiscally conservative in their values, at least, and they wanted steeper cuts. Right. This is from the Freedom Caucus. They were warning they would block the bill if they, as they hold out for steeper cuts. Now, we'll see if they get that. Right. But as long as they don't get that and they get still growth in spending, that is also a net positive for liquidity. So Doge, right? Doge is to cut all the spending. We know that, it's roughly around 50 billion, which is a rounding error when it comes to, the spending packages. I think this is 3 trillion, if I remember correctly. Something like that. So 50 billion is, once again, a rounding error in the grand scheme of things in this big budget bill. So it's not really anything that's going to, I think, hold anything up. At some point, they'll get this through, and it's still going to be fiscal largesse. Now that could change. Maybe those 5 senators get their way, and they're the ones that really force some fiscal conservatism. But the odds are, there'll be some concessions, and they get through a bill that continues with high government spending. So those are net positives. You have to look at that as a net positive, even though I think 30% tariffs are, still a drag on the economy. 30% is high, right? Trump is, it's a part of the deal, go really big, then bring it back. But the reality is 30% still is a large tax. And you have, Walmart talking about higher prices, right? And let's pull that up here. And so they're warning about higher prices, and certainly they have their nose to the ground on this, right? Um, Trump warns Walmart not to blame tariffs, but I mean that's where they get a lot of their products, right? And he thinks that Walmart should eat the tariffs. Maybe you agree with him or not. History says that they won't, right? They're going to pass it along. Maybe they'll eat a little bit of it, etc. But 30%, you can't eat all of that, especially because Walmart. Here's Walmart. What are their margins? I did that. There we go. Their operating margin is 4%. And their gross profit margin is 25%. So even if they laid off all workers and did all their overhead, etc., still the gross profit margin is 24%. Now, obviously, not everything comes from China, right? So there's some room there, but still, operating margin only 4%. I think the weighted average tariff rate is in the 13% range, low teens, which isn't Smoot-Hawley, which is like double that, but it's still extensive, right? And so, with Walmart being, buys stuff from everywhere, and if it's 13% on average, then that's kind of what they're going to be hit with. And so that's kind of where we're at with the economic news. Certainly some tailwinds, certainly some headwinds, but let's go dig into the charts here. Okay. Now let me pull up my market watch list. Let's pull up the NASDAQ, go through this. So the NASDAQ has rebounded here, but we are at, and this is a very interesting market. This is, as you would imagine with the tariffs, this is something that's very difficult to handicap, okay? Because we are at resistance, okay? But we also have recovered. There's 75 retraces about right here. So we've recovered all of that. When you get this high, you typically go to all-time highs. Now, a lot of this is OPEX though. There's a major amount of call volume, and when you get that during OPEX, that typically marks at least a near-term high. So what I'm actually expecting is a pullback. We obviously had, if I go to, let's see, will this show up on a short term? Let's see. This wants to show up on a short term. No, let's go to the Qs. So what you can see on the Qs, this is after hours on Friday. This big drop here. Okay, so this is now down around 514. The market's closed now, so even after hours. So you don't know exactly where this is going to settle out, where this is going to open on Sunday. But the initial reaction was certainly negative to the ratings downgrade. You see that here. Now in the past, it's really been nothing. So I do think it's largely not a big deal. You see the 10-year Treasury selling off as well after hours. So kind of everything's selling off. What was the dollar? Dollar was down as well. Gold was up. Right, I'm just going through. These are 5-minute charts, so these are very short term. You can see the after hours activity. So gold up, dollars, bond, equities down. We'll see if that holds. I don't see it really as the main catalyst. We were already set up for, I think, a down to flat week next week because we're at resistance, because we'll get through OPEX, and the gamma hedging unwind usually happens more aggressively on Monday, especially with this amount of call volume that's expiring. And then, those most of those calls are not rolled over, and that means that the dealers don't have to hedge as much, and that means they sell the underlying stock that they own. And that's kind of how these OPEXs work. When I say OPEX, that's option expiration, and that was yesterday on Friday. So I do think we're going to get some sort of down week, but doesn't mean it has to be the end all be all. That this is the top and we roll back over. It's possible, but I think you have to see where the market closes by the end of the week, see what kind of reaction we generally get. Do you stay above? Say let's go to the S&P. This is the SPX. That was the SPY. So if we get below, if we stay above, say 5,800, that's this level here. And this gap, right? Do we not get in? If we get into this gap's going to get filled, right? We're going to head out to 56. But as long as we stay above this 5,800 level on the S&P, that is generally going to be bullish. Okay, that's generally going to be bullish because it means you've tested the resistance, you're chopping, you're gaining power to break through. If you reverse it and you get into this gap, that puts you back down into this 5,600 level. And now you have a clear lower high and lower low. And I think the downtrend can commence. So it's going to be very interesting to see where this market heads. There's a lot of there's a lot of calls here. Market rallied on Monday, and this was just all, I think, a lot of short covering, gamma hedging into the close on Friday, and all of that. So in a lot of ways, I think this bounce, at least the continuation of this rally, was artificial. And I think we're going to start to get a clearer picture of whether or not this is truly a real recovery or something that was just a mechanical part of how markets work. And frankly, I'm on the fence. To be fair, I don't have a lot of conviction one way or the other. Gold, like I said, gold after hours was higher. This did pull back to a 20-day moving average. Excuse me, 50-day moving average. Red is the 20-day, 50-day moving average, and that's been good support, right? It was back here. Now there is major support, better support down here around the 100-day moving average. Do we get a bounce and then head down there? That's possible, but we were clearly overbought. We had the Barron's cover, etc. And so it's not shocking to see all of this kind of come in. You see that with let's cut that. This is the gold miners. So this is also at support. So you had that rally, pullback, and then breakout, and then you're retesting this breakout level. And that, once again, it tends to be good support. You tested this 2.5 retrace here, you rallied, you retested it, and you succeeded. So a lot of what action I'm seeing over the last few days, plus after hours on Friday, certainly is good for good for the gold market. Let's look at, actually, let me go to the TLT because duration risk is the name of the game here. And what you can see is, let's go to the 5-minute chart and see how much this sold off after hours. Yeah, this is down at 85 and 85.40. And so 85, I think, is big support. And if it loses that, that could be a big problem for markets, right? This is down here. It's basically at the lows after hours. And if the cost of capital starts to break out to the upside, that's going to be a big problem. So I'll be watching for that on Monday as well and throughout the week. Do we lose that level in the TLT, and what type of ramifications does that have for markets as a whole? Let's look at a few other things. The MOVE index. So that has been coming down. I'm assuming this is going to get a spike next week, so we'll be watching that. The NYSE, obviously a broader index. This has recovered even better than all the other indices, but it is still at that resistance level. And do we get a triple top here? That's something that would be pretty bearish as well. Let me pull this here. This level is really the big resistance on IWM. So we'll be watching that. Transportation index did recover pretty nicely throughout the week, so that is probably a positive overall. You had also a strong rebound in, this is floating rate debt. So obviously rates are going higher, the higher credit risk, etc. It's still in a downtrend and something I'll be watching. I'll be watching this as well. This is the private credit index. It rallied, but still below 100-day moving average. So this is private credit versus the ESCA, which is short-term treasury. So you're basically trying to see, is this going to maintain in the downtrend, or is it something that recovers, and that means the credit problems in the markets are probably not going to uh, rear their ugly head. Let's just say that. And so same with the short-term junk to short-term treasuries. This is at a pretty important inflection point. And another data point that says kind of have to wait and see. Does this reassert itself above the 100-day moving average and start an uptrend? Then the credit markets are fine. Or is this all a mechanical rally that doesn't mean much for the medium term? I wish I had an answer for you, but I don't. And so you have to be kind of neutral until the market gives you a better understanding one way or the other. Growth to value, that looked to be breaking out, right? And then that rolled over on Thursday and Friday as well. So something to consider to see where that market heads, because obviously the growth side is going to lead the markets. This is also another one, consumer staples to consumer discretionary. So this fell off in a big way, right? Where discretionary was underperforming consumer staples pretty much since January. And you had that rally. And then what it looks like is this rolled over a bit on Thursday and Friday. Do we get fall to the downside, or do we get this to reassert itself and stay above that 100-day moving average and reassert an uptrend? And then you would say, okay, consumer's fine, the economy's fine, no big deal. Okay. So what you're seeing here, I think you're getting the picture, is there's not a lot of answers yet, because it's OPEX, because we just had this ratings downgrade, because there was a lot of short covering on the 30% rollback. But this is only 90-day pause. Does it really get businesses to feel more comfortable and happy with the tariff situation or not? Right? I don't think so. I don't think 30% or 12, 13% trade weighted is low enough to instill a lot of confidence, especially because of that 90-day pause. Will this reaccelerate after 90 days? Do you order? Because a lot of things take 90 days. If you make them in China, or you place the order today, it's going to take you 90 days to get that here, and sometimes more. And so does that mean when it lands, are you subject to the new potentially higher tariffs? And so I think there's still a lot of pause. And so while things are going to loosen up a little bit, I still think there's some headwinds, along with some of those tailwinds that I talked about. So it's still a wait and see market. And we're waiting for an all clear to really feel comfortable stepping aggressively back into markets in a big way. We're still invested, but certainly have elevated cash levels, but that could change, right? Could go even more elevated if things roll over again, or we could say, hey, markets proved itself, economy is in fine footing, banks are lending again, governments are spending big, and everything's fine. So I hope that helped you, and we'll continue to keep you abreast of how we're seeing markets and what type of information we get next week. Thank you all for tuning in, liking, and subscribing to this channel. And reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.